Good afternoon, everyone, and welcome to Orange Genie's webinar on the Autumn Budget 2017. My name is Helen Christopher, and I'm the Operations Director for Genie Accountancy. This is the second year running we've provided webinars to agencies and contractors, informing them of legislation changes and what it means to them. I'm pleased to say that we've received positive feedback and plan to continue delivering these in the future. Orange Genie Group are an accredited member of the Freelancer Contractor Services Association, the FCSA. Our CEO, Graham Fisher, is a former chairman of FCSA and spends much of his time consulting and lobbying with HMRC. In the past 9 months, we've seen a welcomed focus in the industry on compliance, something we've been pushing HMRC to drive for. So it was really good to see that the Chancellor focused on this in his budget speech. We'll look at this a little bit later. Despite the increased level of commentary and speculation around how contractors would be affected by last week's budget, Philip Hammond delivered what turned out to be a much quieter budget than the previous two, or perhaps what we expected. The last 2 years have been a roller coaster of legislative changes for contractors, both those working in umbrella and through their own limited companies. In 2016, we saw supervision, direction and control tests introduced. These stopped contractors working through umbrella employment from claiming travel and subsistence, and coupled with the introduction of the salary sacrifice scheme, meant their take-home pay was reduced. These changes led to a migration of contractors away from umbrella employment to PSC or limited company models that heavily relied upon the benefits of the flat rate VAT scheme to make them attractive in terms of take-home pay. Inevitably, the abuse of the flat rate scheme on a large scale led to one of the big changes to hit limited company contractors in 2017. In response to the abuse, HMRC removed the potential flat rate VAT savings available by introducing the concept of a limited cost trader. Almost overnight, the attraction of these models, used predominantly by inside IR35 contractors, disappeared, but left all contractors affected. HMRC went further in 2017 and introduced the off-payroll rules in the public sector. Moving the determination of IR35 status away from the contractor to the end client or agency resulted in many public sector bodies taking blanket status decisions and chaos for a lot of contractors. 2016 and 17 have been difficult years for both umbrella employees and limited company contractors. Thankfully, there were no imminent changes announced for 2018, but there is still much for us to think about. The much speculated off-payroll reform in the private sector was not directly mentioned by the Chancellor when he was on his feet last Thursday, but mention was made in the budget booklet shortly after he sat down. With claims of the new public sector rules being a success and the government desperate to raise revenue, a private sector rollout is clearly attractive to them, and the question seems to be when rather than if. The good news is that whilst HMRC are still focused on ensuring that individuals who effectively work as employees are taxed as employees, they're not rushing into immediate change in the private sector. It would seem that HMRC have recognised the need to proceed with caution, and they will seek to take into account the views of businesses and individuals who will be affected by the changes during 2018. Interestingly, HMRC's language around the rollout to the private sector is much softer than we've seen before. They refer to early indications of increased compliance in the public sector and a possible next step. The question of increased compliance is a contentious one. Rather than look on a case-by-case basis at a contractor's status, many public sector bodies took sweeping blanket decisions about IR35, despite the legislation requiring them to apply reasonable care. The tool provided by HMRC to assist public sector bodies make their decisions, the Employment Status Indicator, continues to receive much criticism for being unfit for purpose. The tool ignores one of the fundamental factors in deciding employment status, the question of mutuality of obligation. Case law precedent built up over many years has been omitted from the decision-making process behind the tool, and as such, many just simply won't use it, seeing the tool as HMRC's attempt to change the rules on IR35 to suit their purpose. Interestingly, there's no mention in the budget document of the increased tax hike that HMRC predicted from these changes. Perhaps they've realised that all may not be as it seems. Whilst I'm sure they will have increased the tax take from contractors now found to be inside IR35, whether legitimately or as a result of the blanket decisions I talked about earlier, they perhaps didn't anticipate the increase in day rates needed to retain and attract the necessary talent and resources to complete projects. This increase is around about 30% in a lot of cases. I imagine the private sector will have a lot more to say about both the unreliability of the employment status indicator tool and the potential for increased rates if the rules are rolled out to them. The political background right now is uncertain, but business is being heralded as the backbone of the UK and a key to our success post-Brexit in March 2019. Consultation during 2018 will be interesting. It will provide an opportunity for all interested parties to express their views and to be consulted. FCSA will of course be part of these discussions. I suspect the government may find there is a stronger opposition to these rules from the private sector than they have faced to date. But for now, despite the uncertainty ahead, it's business as usual for contractors working in the private sector and a good time for public sector workers to reflect on the changes. Looking after thousands of contractors and venturing around the country meeting with agencies and individuals, Orange Genie are well placed to comment on what we're seeing as the effect of last year's changes in the public sector. Those in limited companies and operating in markets where they could transfer skills to the private sector took advantage, so business is normal for them, whilst the public sector lost valuable resources. Others with less transferable skills remained in the public sector, and many chose to use an umbrella employment solution or go PAYE direct with the public sector body. Those choosing to go PAYE direct through public sector bodies may have lost access to full employment rights, continuity of employment and flexibility in the workplace, and many have begun to reconsider this decision and are moving back to umbrella employment. We've also seen an unprecedented upturn in people coming back to umbrella employment, generally being those contractors who were using the inappropriate PSC model I talked about earlier to increase their tax take-home via the flat rate VAT scheme. More worrying, though, is the mass migration of contractors towards the offshore loan scheme providers. The spotlight is currently on the healthcare sector, where an advertised 95% plus take-home pay has blinded people into using such unscrupulous schemes. There is also some evidence that this is happening in the education sector. Unfortunately, these schemes prey on the vulnerable and those seeking to maximise income. These schemes purport to pay a small salary and to offer the remainder of the earnings through a loan arrangement. The loan amount is not taxable whilst it remains repayable. HMRC have made it quite clear they will not tolerate these arrangements and have been proactively closing down such schemes. The budget announced additional resource to investigate these non-compliant schemes, and there is a duty to report such providers to HMRC. It is no defence to say that you didn't realise you were entering into such a scheme, and HMRC have extended their powers to investigate non-deliberate avoidance now to 12 years. If the scheme you are using is caught, the bills for the non-paid tax will fall on you, the contractor, and not the scheme provider. So it really is a case of if it seems too good to be true, it probably is. The best advice is really to stick to the rules and use a compliant provider. Your tax paid may seem higher than that offered by these alternative schemes, but in the long run the compliant route is cheaper than the fines and penalties that can be added to outstanding taxes if you are investigated. The introduction of the Criminal Finances Act 2017 has highlighted the risk of advising contractors to consider these non-compliant schemes. Agencies are aware of their responsibility in the supply chain and the potential for facilitating tax evasion schemes. Many are now beginning to carry out the required levels of due diligence to ensure that they and their contractors are not caught by such schemes. As you'd expect, the Chancellor also announced the annual changes to the tax thresholds and allowances. The simple table on the screen shows the changes over the recent years and the Government's manifesto pledge to reach a personal allowance of £12,500 by 2021. The main points for contractors to note are that the expected increase in personal allowance continues, meaning more tax-free pay for all. The basic rate band increased slightly, meaning slightly less pay being subject to the higher rate tax rate. There were no announced changes to the additional rate for those earning over £150,000 per annum or more. The Chancellor confirmed that the tax-free dividend allowance announced in 2016-17 is reducing from £5,000 to £2,000 in 2018-19. Although this is a reduction, we should probably be relieved that it was not reduced further, as many were predicting before the budget. Corporation tax rates will remain at 19%, with a view to falling to 17% by 2021, and there were no announced changes to the tax-free capital gains allowance for individuals, which remains at £11,300 for 2018-19. As usual, the Chancellor announced the annual increases in the national living and minimum wages for all age groups. The national living wage for those over 25 will rise to £7.83 from £7.50 from April 2018. There are increases for all other age brackets too. 21 to 24-year-olds will now earn £7.38 per hour, 18 to 20-year-olds £5.90, under 18s £4.20, and the apprenticeship rate will be £3.70 per hour. Turning to the question of VAT, prior to the Chancellor taking to the floor last Thursday, there was some speculation that he may reduce the compulsory VAT registration threshold from £85,000. The UK limit is considerably higher than any other European country, and this move would certainly have increased HMRC's tax take. However, the Chancellor outweighed these arguments by acknowledging the attractiveness of our current system to small business and recognised the need to continue to encourage entrepreneurism and trade. The compulsory VAT registration limit will therefore remain at £85,000 for 2 years, whilst HMRC consults on where this should sit from 2020. With Brexit due to be completed in March 2019 and Making Tax Digital close on its heels in April 2019, it will be interesting to see where this thought process goes. Last year's addition of the low-cost trader definition to the flat rate VAT scheme has seen no further amendments. The flat rate scheme remains an option for many, but the attraction has reduced, so we are seeing a much lower number of voluntary registrations for businesses below the compulsory threshold than we were a year ago. Other areas of interest hidden in the budget small print were few and far between, but I've listed just a few that might be of interest to contractors. From April 2019, employers are no longer required to check receipts when reimbursing employees for subsistence where benchmark scale rates are used. In addition, there's going to be a consultation to extend the tax relief available for the employed and self-employed who invest in their own training. From April 2018, there'll be no benefit in kind if you choose to charge your electric car at your employer's premise. No changes to national insurance for the self-employed will happen in the immediate future. HMRC are going to review the whole of the national insurance system for the self-employed and have put on hold changes they announced in the previous year. HMRC have also announced that they will look to use new technology to recover additional self-assessment debts in closer real time. They're aiming to do this by adjusting tax codes sooner for those individuals who have PAYE earnings, and they expect these changes to come into effect from April 2019. The government are consulting on reform to the penalty system for late filing and payment of taxes. We don't yet have any detail, but it's understood that this will be a points-based system across all taxes. So this afternoon's short presentation has highlighted the key areas of the budget to affect contractors and freelancers. It was much quieter than expected and introduces no imminent big changes, but obviously leaves a lot open to consultation during 2018. Thank you for attending today's webinar. We hope you found it useful. During the course of the presentation, we received numerous questions, and to make sure we respond to them fully, we'll send out a transcript of the questions and answers with this webinar recording. Once again, thank you for attending.